Welcome to Fraud Friday. I'm Bob Coleman, and we're talking loan fraud. Bankers, public officials, and borrowers who got caught. Today, we're talking about the Richmond way. I normally don't do pop culture references, but for you Ted Lasso football English fans, we're talking about Richmond City, Indiana, not England. CEO of a credit union. He was indicted for a $300,000, $285,000 loan fraud where he made loans to fake accounts that he pocketed the money. Here's the problem. Very small credit union. We're talking $8 million in assets and three-person operation where he did everything. Even though he was the CEO, he did everything and he had two employees working for him. So no internal controls. The problem is the credit union failed. Why? It had a 2.3% capital ratio. Don't worry, I'm not going to get into macroeconomics on bank capitals, but just to put that 2.3 in perspective, credit unions demand a minimum 7% capital reserve, banks 4.5%. So they were way undercapitalized, which means they did not have enough equity skin in the game to make the loans that they did. In his role, Johnson's duties encompass virtually all operational functions as well as supervision of the two employees. Quote, he had substantial authority in the credit union's underwriting and processing of loans for members. That's the first red flag. You cannot have, as a lender, you cannot have an underwriter be involved in the approval process. And he obviously controlled the board in this situation and told the board what loans to approve. You need to have a clear firewall of separation between, I misspoke, I meant between the business development origination and the underwriter. The underwriter, of course, approves the loan, but you cannot have that business development officer, the person who's facing the customer, facing the potential borrower, to have authority to sign to approve the loan. And that's what he had in this situation. Credit union employees were permitted to apply for loans, but they needed the board approval. And we're talking small credit union. They can only do $10,000 unsecured, $150,000 secured loans. The two loans were supposedly for Winnebago and vehicles. They weren't there. So you had way over their legal lending limits, and that caused the credit union to fail. And credit unions are unique financial institutions, very small. They only had about 788 members and small dollar amounts. I'm fascinated by the credit union model, and that could be an interesting topic for another day. But the bottom line is this happened in 2022. The credit union failed. Wheels of justice moved slowly. 3 years later, he was indicted. Thank you for joining us today for Fraud Friday, so you can stop criminals from stealing from you.